Hello everyone, this is Kevin Zhao. After reading this chapter, you should be able to first understand the features of both call and put options. Second, describe the option trading mechanism. Third, analyze basic option trading strategies. And fourth, understand the valuation of options. Financial derivatives are contracts between buyers and sellers that transfer ownership of certain assets in the future at given prices. Derivatives allow investors not only speculate on asset prices, but also provide them with flexibilities to manage various risks. In addition, derivatives contribute to market completeness by improving price efficiency. Options are rights to buy or sell a certain number of securities within a specific time period at a given time, at a given price. Option markets expand investors' investment opportunities, lower the transaction costs, increase leverage, and improve investment efficiency. There are two basic types of options, call option and put option. Call or put options give buyers rights to buy or sell on or before the expiration date at the exercise or strike price. Those rights are not free. Option buyers need to pay option premium to get those rights. If investors use option for speculation purposes, then call option buyer bet on price to increase and put option buyers bet on price to decline in the future. In other words, call option is a bullish bet and put option is a bearish bet from buyer's perspective. Options are traded both on exchanges and over the counter. Option exchanges such as CBOE, ISE provide trading liquidity to investors. Standardized option contracts in expiration date and exercise prices. The Option Clearing Corporation facilitates option trading settlements. Here you see the payoff for both call option buyers and sellers. For option buyers, the option has an exercise price of $25 with a premium of $4. The blue line shows that the maximum loss for buyer is $4. If in the future stock price is lower than $25, buyers begin to make money when stock price is higher than $29. In between, although buyers make money by exercising in money option, but the gain is offset by the price paid for the option, leaving investor net losses. The option sellers have the opposite payoff. This graph shows the payoffs of put option buyers and sellers. Option premium is the maximum gain for sellers and the maximum losses for buyers. Buyers make money when prices decline, and the sellers make money when prices increase. Option is a zero-sum game because any gain and loss for buyers must be the loss and the gains for sellers. There are many option trading strategies that an investor can implement, and we will introduce several of those a little bit later. The cover the call strategy is a strategy where call option seller use stock position to protect the call writing position when stock prices increase dramatically in the future. As we know, a naked call writing position will suffer from losses when stock prices increases. When additional position in stocks, those losses can be offset by increase in stock price. A covered call strategy also replicates a position for put option seller. The protective put strategy is a strategy where stock investors use put option as an insurance. Any potential losses in stock can be compensated by gains generated in put option position. The protective put strategy is a very popular strategy for many mutual fund managers since 1980s. The protective put strategy replicates a call option. So the alternative for investors who want to have an issued stock portfolio is simply a call option position. If stock price S is greater or less than the exercise price E, then the call option is in or out of the money. For put option is the opposite. An option price consists of intrinsic value and the time value. For both call and put option, the blue line shows the intrinsic value. Yet, the option price showing the dashed curves are always greater than its intrinsic value. The differences are time value. As long as the option is not expired, the time value is greater than 0. On the expiration date, the option price must equal to its intrinsic value. The green line shows the upper boundary for call and put prices. What are determinants of option prices? Dr. Black and Dr. Schultz developed a quantitative model back in 1970s to precisely calculate call option price. Both Dr. Black and Schultz won the Nobel Prize in 1997 for their path-breaking contributions to the option pricing theory. The Black-Schultz option pricing model is for call option. What about the put option price? The put-call parity can help us to calculate the put option price if we know the call option price. The Black-Schultz model looks intimidating to many students. Here you can see no matter how complicated the model is, there are only 5 factors ultimately determine the call option price. They are stock price volatility, stock price, exercise price, time to expiration date, and the risk-free interest rate. All 5 factors have positive relation with the option prices, except the exercise price for call option and the stop price for put option. The hedge ratio can be viewed as option price sensitivity to the changes in stock price. Stock index options are options that make stock market indexes as the underlying assets. Stock index options are a great tool for investors to manage their equity market risk. This is Kevin Zhao. I hope you enjoyed this video, and I will see you in next class.